Okay, so just to kind of recap from yesterday a little bit, we talked about savings and investing, okay? Of those two, saving against investing, which one of those has the highest reward if done correctly? Investing, right? Because you got a chance to make a lot of money. Now, obviously, it carries the most risk too, because you could lose money, correct? Savings is you put it in an account, it's going to draw interest, and it's always going to kind of be there until you move it out, okay? So, what we're going to talk about with this, and I can't remember exactly how far we got, but we got investment in human and capital and technology, and what we're trying to do is increase productivity. So this is from a business standpoint, okay? So we're trying to make as many of a product as we possibly can make in order to make money at the cheapest way, the cheapest level we can do it at, okay? So this one, fairly simple, I think. So we're going to try to increase productivity by result of advances in technology and improvements. And then we're going to invest in physical and human capital that can increase productivity and thus raise future standards of living. So there's still standards of living around. Which brings me to this point. Y'all guys remember what GDP is? What does GDP stand for? Gross Domestic Product. And all it did was what? Y'all remember how we looked at gross domestic product?
It's how much money the USA makes.
Yeah, it's the total market value in dollars of all the goods and services that's been created. Right, Jason? So basically, everything that's been produced, that's how much it's worth. That's our gross domestic product. And I told you that the U.S. has trillions of dollars in this, right? And then what did GDP per capita measure? The standard of what? Standard of living, right? You guys got to get this stuff in your head. We take the gross domestic product and we divide it by the population. You guys remember me talking about that yesterday? And that's each person's share. That's how it would work out if we shared it equally. Now, obviously, we don't share it equally in the U.S., right? But that would be what it would be if we did. So you guys got to have that in your brain, okay? So today we're going to talk a little bit about investing, and we're just going to go through a couple notes here, and then I'm going to show you the slides that I have on another program, all right? So it says people invest in their human capital through education, training, and experience. And I'm pretty confident we already wrote that part down, did we not? Or did we? I got us to human capital in my notes from yesterday.
Yeah.
So basically, we invest in ourselves, right? We're going to go get training, we're going to go get educated, and we're going to go to try to get experience in order to create an investment in us that would be more money than usual, right? We want businesses to invest in us, but we want to make a lot of money. In order to make a lot of money, education, training, and experience helps do that. You guys understand what I'm getting at there? If I just go into a job with no type of experience, or am I going to start out at a high salary? No. But if I go into a job with a lot of experience, the probability of me making more money is higher. Okay? And then we talked a little bit about how we increase production through other means when it comes to human capital. And we talked about how we try to do our jobs as efficiently as we possibly can. And how do we do that? We talked some about the assembly line and how we use tools and machinery to help us. Y'all remember that from yesterday? So, what we're going to get into now is a little bit new. So, it says workers also can improve their productivity by using physical capital, which is tools and machinery. That should be the last part that you have written down in your notes. So everybody got that? Okay. Common sense, guys. If I can make a machine that will create 50 times more stuff than what I can by myself, it's probably a good idea for me to try to purchase that machine. It's probably going to be expensive to start with, but over the long haul, it'll probably be worth it, right? Okay. So, moving on. The next thing we're going to talk about is technology and how it can increase productivity. So in your notes, write down the word technology. technology. All right. Now, I don't probably have to say a lot about technology. You guys have grown up in an era where technology is king, right? You know, when I was your age, I didn't have a cell phone. Didn't need one. Nobody needed it. You guys probably think of something like that. It's like, how on earth did you survive? Well, we didn't have TikTok and Facebook, and you know, we were the ones out doing all that stupid stuff. We just didn't film it. You know what I mean? So, technology has came a long way. Okay, so research and development can lead to increased productivity. So basically, we're going to put down research and development. Leads to increased production. If we are constantly trying to improve and constantly looking for ways to make products better. Now again, guys, this is from a business standpoint. Okay? It says technological change can lead to increased productivity. Improvements in processes and procedures can also increase it. So, right under research and development, draw you a little arrow, or whatever how you like to do your notes, because I want this under research and development. And put down that it improves the process, research and development, improves the process and procedures. Improves process and procedures. If we can do things more efficiently, we can get them done more effectively, right? Common sense stuff, okay? And then lastly, how do we increase productivity through investments and things of that nature? It says the rate of productivity increase is strongly affected by what? What does it say up there? Incentives. We learned what an incentive was the other day. What is an incentive? How many different types of incentives are there? There are two, positive and negative, right? If you are offered a reward, if you get, say you work in a factory one of these days and you can crank out 30 units of something a day, and then they give you a machine that says it can crank out another 30 a day, and your boss says if you can get 75, I'll give you a raise. Well, you're used to getting 30, the machine's going to give you 30, and you think, well, maybe if I can get 15 more, I'll get more money, right? Well, you're working hard to get that money, right? And what are you also doing for your boss? Creating more products so he can make more money as well, right? So, it says the rate of productivity increase is strongly affected by incentives. So, the net reward through successful innovation and investments in research and development and in physical and human capital. So, below all this, here's what I'd like for you to put. Put down through investment. And what I mean by investment is investing in yourself and investing in the tools to make jobs more efficient. So through investment and technology and incentives. Comma. Productivity will increase. Okay? Productivity will increase. So this is a question you'll probably see on your next test or quiz. I'm going to say, how do we increase production? And you're going to tell me how. Through what? Investing, through technology, and incentives. Does everybody understand that? Pretty simple, right? Okay. Now, that's literally it as far as that little SOL goes. So at the bottom here, now again, don't get confused. At the top, the investment we're talking about is through business. Y'all got me? How do they increase production? What we're going to talk about now is savings versus investing, okay? So, you guys already have an idea about investing and saving. I can save money, and that's the easiest way to go about doing it, right? I can put it in a bank. They'll pay me a little bit of interest on it on a yearly basis, 6-month basis, however how you want to look at that, right? And it's always going to be there, and I'm going to gain a little bit as we go. Or I can take that money, I can invest it in the businesses or in the stocks and the bonds and things of that nature, and hope that they do really, really, really well. Like, wouldn't you like to put money in Amazon when it first came out? Amazon's a multi-million-dollar business now. If you could have bought stock in Amazon right when it came out, you'd be a millionaire. You know what I mean? Same thing with like Apple. All these phones you guys carry around, Samsung. Wouldn't you have liked, when those businesses started, to have invested in them and let them help your money grow, right? Now that's all. Yeah. There is, obviously that's the good side of it. You know what I mean? When I invest money in something and my money keeps growing because that business keeps growing, that's a good thing. Could you invest in a business and it sink? Yeah. And whatever money you invested, guess what? You're out of. You're not getting it back, okay? So investing is a more high-risk, high-reward situation. The key is to find investments that grow steadily over time. You understand what I'm getting at? But they kind of grow at a higher percentage rate than what a normal savings account would. But anyway, we're just going to talk about a simple introduction to investing. So I'm kind of grouping productivity and investment together here. You guys understand that? So pay close attention to what we're doing here. It says thinking about future finances may be intimidating for most young people. Let's be honest. How many of you guys have ever thought about how you're going to spend money or do things one of these days? You hadn't yet, right? You're what, 15, 16 years old? You're probably trying to figure out what it is you want to do in life, right? But the earlier you start on thinking about investing in your future and trying to save money and to make money, the better off you are. Like I would love, and most people would tell you this, to be able to go back to when I was about 22, 23 years old and know what I know now. Because if I knew what I knew now, then I would have invested in a lot more things. Because I'd have got more money, I'd have gained more money over time. You guys understand that? So investing can be a really crucial thing. I've had friends who's invested in things, who's paid off vehicles, who's paid off homes, who's done really well in investments. Okay, so but most young people, but there's a reason that experts recommend investing at an early age. So we're going to talk a little bit about why people think you should invest early, like in your early 20s. The earlier you get started, the better the outcome. Y'all with me? So, as we scroll down through this, if I can get it to work, my computer. Okay. Eventually, we're going to start talking about compound interest and how the powerful force of building it will help you with your wealth and saving for retirement. So, savings versus investing. Write that down underneath individual investment. Saving versus investment. Now, I know we've talked about this, but I just want to make sure we have an idea. It says when it comes to money, the terms saving and investing can be used interchangeably because you're kind of doing one or the other if you're trying to put money back. You guys with me? You're either trying to save it, or if you invested in something, you're trying to make your money grow. Y'all with me? So they can be used interchangeably, but it's important to understand they have a lot of differences, and we know those. Savings is a real steady, calm, I'm going to make a little bit of money over time deal. Investing, I could make the possibility of making a lot of money at one time, all right, or I could lose everything I got with it. So while both are ways to accumulate financial resources, they each are used to accomplish a specific objective and take place over different time horizons. So we're going to look at this this little chart right here. And the guys online, I'll send this to you so you can look at it as well. Okay? So, when you compare saving and investing, on the left you have saving, on the right you have investing, and it's talking about the objective. Underneath saving, it says that it's safe and optional. All right? The process of putting cold hard cash aside so it can be used in the short term on a minimal notice. So, underneath savings, draw you a little line or something. We're kind of going to do this as a chart on your paper, if that makes sense. So, underneath savings, we're going to put down safe and optional. Because it's hard, guys, does everybody have the ability to save money? No, not everybody can, right? So, it's optional, okay? So, but it's safe. Now, what do I mean by safe? What can a savings account be used for? If you jump down to where it says can be useful for, it says saving up for a purchase. So, you're saving up for a purchase, so put down for a purchase. Maybe you're trying to buy a car or a motorcycle. I know you're still into those, aren't you, Jace?
Yeah, I just got one 2 Saturdays ago.
Did you? So you may have to save up money over a long period of time. You know, a lot of things people save up for aren't cheap, right? So they put money aside in order to do things like that. So they're safe or optional. And they usually do it for a purchase or an emergency fund. Put down emergency fund. Say your roof starts leaking, or the engine in your car goes out, or you know, something you wasn't planning on having to pay for. Something happens of that nature. All right. So, and then at the bottom there it says average annual return. So what that means is over a year you're going to draw 0 to 2% on a savings account. Does that make sense? So in order to figure that out, basically for every dollar that you put into a savings account, if it's a 2% interest, you're going to draw 2 pennies on that dollar over a certain amount of time. In a year, that'll end up being, you know, around $100. It may end up being $2. Could end up being $2.50. The idea is the more money you put into a savings account, the more it'll grow, because, you know, 2% interest on $100 is not as much as 2% interest on $1,000. You guys get that? So if it's on an annual basis, just to give you an idea of this, let me jump out my little handy dandy calculator. If I've got $100 and I want to know how much interest I can make on it, at 2% interest, that's $2. Y'all got me? If I have $10,000 saved, and I multiply that by 0.02, my 2% interest is $200. So there's a big difference there, right? So the more money you can put back, the more average earning or annual return you'll get, okay? So that's a savings account. Safe, mostly for a purchase or an emergency fund, okay? Now, look over at investing. It says for investing, it's long-term financial success. It says the process of putting your money to work over the long term by buying and holding assets that will grow from compound interest. And we'll talk about compound interest a little later. But the idea is to invest in something, and whatever you invest in, whether it be a business, whatever, you want that business to continually keep growing and getting bigger and bigger and bigger. You understand that? And over a longer period of time, that money that you invested will keep growing. Because if you buy that, they're going to pay you an interest rate on what you got. Say you get 10% interest back on an annual return. That's high. That's good. Anything above 8 is good. Okay? So under investment, put down long-term financial success. Long-term financial success. Okay, what we're doing, and I'm going to spell this out a little bit, What it means by long-term financial success, guys, I would like for you to jot down that you're letting your money, you're buying and holding assets. So put down buying and holding assets. Now, what do I mean by assets? What do you guys think the word assets mean? Come on, think.
Money?
It's not money. I'm putting money as an investment into it, and what I'm getting back is an asset. I'm getting a piece of something. You guys understand that? If I'm putting money and investment into a business, I'm getting a piece of that business. And as that business grows, what's my piece of the business also doing?
Grow.
It's growing. More money, right? If I invest in stocks, I'm putting money into businesses, hopefully so it will grow, okay? So, some examples of assets. Personal assets. Cash. I want it to grow, right? So I'm going to put it in different things. Savings accounts. Treasury bills. Can property or land be an asset? Could I use my property to buy something else?
If you sold it?
No. I could go to the bank and say, I need to borrow X amount of money. And they're probably going to say, well, if you can't pay this back, what are we going to get in return? Well, say you own 50 acres of land that's worth, I don't know, $50,000. Like, well, I'll put my land up against it. If I put my land up against that, I'm going to make sure I pay that bill off, because if I don't, what's the bank get? My property, right? So it's an asset. I can use it to gain wealth. You guys understand that? Boats, jewelry, vehicles, all those are assets. I can use them to make money. You guys understand what I'm saying here? So, investment is a long-term financial thing where you buy and hold assets. Okay? Now, underneath that, it gives you some examples of assets, and we're going to jot a couple of them down. So, underneath assets, write down stocks. You guys know what stocks are?
Stocks?
No, I'm being serious. Talk to me. What do y'all think a stock is? We're going to play the stock market game in here where we actually invest in businesses and see if our money grows. You know what I mean? But a stock is when you buy a piece of a business, and hopefully they keep selling products and doing well, and your money keeps growing with them. Okay, so that's a stock. A bond. Anybody know what a bond is? A government issued bond. Y'all never get bonds for Christmas? Your grandparents never bought y'all bonds or anything?
Kind of bonds. There's two different kinds.
What kind? What are you talking about?
No, like get.
We're not going to jail if that's what you're referring to. A government bond is, say I go to the bank and buy $100 worth of government bonds. I can go put that bond up and it's going to draw interest for me. Y'all with me? It's just a piece of paper. It's a government issued bond worth $100. I can keep that bond for the next 25 years, 50 years, 75 years. Don't matter. At the end of the day, and at the end of that 75 years, I can go cash that bond in and it will never decrease in value. You guys with me on that? So if I paid $100 for it today, in the year 2090, when I go back to sell that thing, it's the least amount of money I'm going to get is $100. But the majority of the time it draws interest, and the government's going to pay out a lot of money for it. You guys with me? So bonds, you're investing in something, putting your money into something, okay? We'll get into mutual funds and index funds later, but the last one I want you to write down and put down the word property. I told you a little bit about that. That is an asset. And guys, property don't necessarily just mean land, okay? It can be cars, it can be your home, it can be your farm, it can be jewelry, you know, family heirlooms, things of that nature. All that you can be used to try to make money. All right. Now, the average return on stocks is 6 to 10% interest. So if I just showed you those two numbers, which one's the higher reward?
Investing.
Investing, real easily. Which one you think you're taking the most risk in though?
So
Investment. Because could those businesses that I'm putting my assets into go flop? Yeah. Okay. So Savings, slow and steady. You're going to make money. It's just going to take a really long time to do it. Same concept with investing, but you're going to make a lot more money over a longer period of time. Is the hope. Y'all got it? Because you draw a higher interest rate on it. So you guys know who Warren Buffett is? Warren Buffett got more money he knows what to do with. And he got all of his money by investing. Okay? He says investing is the process of laying out money now to receive more money in the future. Now, guys, he makes it sound simple. I'm telling you, it's a possibility you can lose everything with investment. All right? But what he's saying is if you're smart about what you invest in, you're going to make a lot of money. Okay? Says the difference is much clearer when we look at growth in wealth over time. Okay? So what he means by that is basically he's put $2 down now, and at the, later he's going to collect 10 or whatever. Does that make sense? But you got to invest correctly. So money over time. So basically what they've done is took a savings and an investing, and they've done it through the years. 1 year all the way up to 40 years. Y'all got me? And if you noticed up here, I said that you draw 2% interest on a saving. That's on average. You got me? So the bank will pay you 2% on savings accounts. And investments, you get anywhere between 6 to 10%. All right? So obviously a lot more money can be made here. You're tripling at the lowest point of your interest on it, which is really good. Okay? So over a 40-year period, if I start out, and I think it's saying that I'm starting out around, what, about $1,000, I guess? Wouldn't you guys agree with that? Over a 40-year period, at $1,000, it says in short term, saving and investing doesn't appear to look that different in terms of return. Well, if you look at it over the first about, what, 7 or 8 years, there really is no difference, is there? Over about 7 years, saving or investing, you really get about the same thing. Okay? But now, as time goes on, and that's why it's important you do this early in life. Okay? If you guys are, what, 15, 16 years old? See, so you can invest right now, and in 40 years, you're at 55, and you're going to gain almost $20,000.
Well, that's if you put it in an investment. That's not if you put it in the bank, right?
Right, that's in an investment, and that's if your investment does well. You guys understand what I mean? That's the risk you're taking. Now, over that same 40 years, I can put it in a savings account. And when I get to 40 years, that $1,000 is turned into $2,165. So I basically doubled my money, right? But it took me 40 years to do it. Well, I've got 1,000 here, and at 40 years, I'm at 20,000 there. I 20 times my money with an investment. So obviously I invested well, right? Now, could this right here go straight down? Mm-hmm. Absolutely. This one's going to stay par for the course. That's going to happen. You with me? That's safe. That will work. And investment, that's what you want it to do. And if you invest properly and you do your research on what you're investing in, that will happen. Does that make sense? But you got to be smart. High risk, high reward when it comes to investment. Calm and steady when it comes to saving. Okay? So in the long term, investment uses the power of compound interest. So what do you guys think I mean by compound interest? I don't want to write it down yet because we got a whole other section on it. But compound interest is, it takes a lot of interest into consideration for you. It's helping you out. Compound interest is a good thing. Okay? Very, 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 very good thing. All right? Does anybody have any questions so far? So far, so good. And guys, compound interest is just interest on top of interest. Okay, it's double interest, triple interest on things that we have. Okay, so in this case, buying and holding investments will produce more closely 10 times larger than the savings, which makes sense. Savings is at 2,000, investing is at 20, so you gain 10 times more by investing if the investment works out. Okay, so why wouldn't a person only invest instead of save every single time? And we've kind of talked about this a little bit. If you got the opportunity to make your money 10 times larger than what it was, most people are going to do that, right? But if I told you there's a chance that it's not going to end well, that you could lose your money, it makes people think really hard. Because when you're thinking about a lot of money, you kind of want to keep it. Like, for example, say you got $100 in your pocket. Okay? I go, Casey, if you give me that $100 over 10 years, I can make it 10,000, or I may not be able to give you anything back. What would you say? It's hard, right? Because you're like, it's $100. I've got $100 in my pocket. But I'm telling you, I can maybe turn that into 10,000, or may turn it into nothing. Now, if I look at you and say, Casey, you give me that $100, and I guarantee you in 10 years it'll be 150. That's more of a guarantee, right? So
That's all I had, I just keep it.
well, you understand what I'm saying,
You're
though.
getting $50.
Right, but that's how a savings account kind of works, slow and steady. You got me? So, if we can increase our money through investment tenfold all the time, why don't people do it all the time? Okay? So there is a catch to investments. Okay? It says in the investing world, the expected return that you get tends to come at a corresponding level of risk. Okay? So what does that mean? And we don't have to write any of this down, I just kind of want to show it to you. Let's say that your percent of return is less than 1%. Say it's 0.72. Okay? Say it's the risk, and I've got cash. The risk is the lowest because the return is the lowest. You guys with me? What that means is I may invest $10, and at the end of the day, I may only make 12. That's not a lot of money. You know what I mean? So the risk is kind of low there. But the higher your interest or your return goes up, the higher percentage of return. And what it means by that is the amount of percentage you get back on your investment. You with me? The higher that it goes, the higher that the risk becomes because it could fall apart. It's volatile. Okay? So, holding cash, example being saving, provides almost no return. But also, it's the lowest risk. Guys, it's the same thing I've been telling you. Savings is the lowest risk, lowest reward. Investing, high risk, high reward. Okay? So, what is risk? It says investments come with volatility or risk, meaning that means that returns can vary each year. Guys, look at this chart. I don't know if I can make it any bigger. Let's see if I can make it any bigger. Oh no. I can't. So, all these things above zero, you guys see this? Is stocks and bonds. Well, one year the bonds are in purple. Bonds done really good in 2014, didn't they? Gained about 6% return. What happened to them in 2015?
Went to zero.
They dropped. I lost about 5%. Now, if I lose 5%, I've lost some money there. I may be thinking, well, I need to pull out of this. I need to get out of it and save what money I got. Or I can leave what little money I still have left and hope that it rebounds, right? So let's say I left that money. Did we rebound a little bit the next year? Yeah. Rebound a little bit more the next year. Yeah. So it would have paid off if I'd have left my money in there, right? Well, look at stocks. Let's say I put money in stocks, bought some assets in a business, gained 5% first year. That's awesome, right? That's a good deal. The next year I lose 5%. So now I'm like, oh man, I'm almost at zero. This company's going to fold. Should I pull out? Should I stay in? Let's say I pull my money out of it. I break even. Okay? Well, then the next year that company skyrockets, gains 21% on its interest, on its investment. I just lost a lot of money, right, because I didn't stay in it. So investing is a long-term situation. It's going to go up and down, they even flow. You guys with me? You just got to kind of stay with it and know when to pull out and know when to stay in, okay? So, however, what I'm getting at, in the long run, this can create big returns. If you'll stick with it, you can make some money, okay? Yeah, you may lose a little bit here and there. You're going to gain a little bit here and there. But at the end, the idea is the business keeps growing. And whatever you put in a long time ago is a lot more when you decide to take it out, okay? So, with this being said, you got the S&P 500. Do any of you have a clue what the S&P 500 is? It's basically stock you can buy in 500 companies. Let's kind of group them all together, okay? And I'm going to show you an example of the S&P here in a second online. So, If you'll notice, this is a chart from 1990 to 2018 on how the S&P has grown. So, like the S&P has places like McDonald's in it. I can't think off the top of my head. Let's just look it up. Let's just look it up while we're sitting here. Give you some examples of the S&P. So, some of the companies that make up the S&P are the 3M company. I know you guys have seen that some. Advanced Auto Parts. Let me think. Allstate, Amazon, American Electric Power, AEP. There's a ton of them. Anyway, there's 500, okay? AutoZone. CarMax, Chevron, Cisco, Colgate. So the idea is they group them all together, and I can buy stock in all of them at one time. Okay, so the S&P today. Let's see what it's trading at today. So to give you an idea how this works, and I will look at this graph here in a second. That's the S&P today. Okay, so right now, if you wanted to buy stock in the S&P, it would cost you about $3,357. Stock market, I don't know if it should be open, but it's not showing anything yet. Yeah, there we go. So right now, the S&P is up 37 cents on a dollar with a net gain return of a little like 0.011. Now you see how that's constantly changing? It's up $4.34 today. So if I were to have bought this at $3,350 and it's up $4, I'd gain $4. That's not a lot of money, right? But the idea is it gains $4 today, gains $2 tomorrow, gains another $1 the next day. It continuously does that. You guys understand what I'm getting at? And then over 10, 20 years, the idea is I continue to make money. Okay? So if you look at the chart we have, you see how it has peaks and it has valleys? If I wanted to buy in the S&P, if I wanted to invest in it, where would be a good time to try to buy?
Really?
Right. Either right here, or right here, or right here. Why?
It's cheaper.
That's when it's the lowest, right? And the idea of that would be that it does what?
Right.
Keeps going. Now, if I'd have bought right here, everything looked good for about 4 or 5 years, right? And then what happened?
Right.
Had the economic recession in 2008, right? So we lost some money. All right. Let's say I stayed in it. I lost a little bit of money, but I kept what I got. What's it done now?
Right.
Over the last 10 or 15 years. Made a ton of money, right? So long-term effects, that's what we're trying to get at, long-term effects, okay? So this next one is asking you what should we invest in, okay? So what kind of ideas is it we should invest in? Should I take what money I'm going to invest and put it all in one thing? What do y'all think?
No.
Yeah, y'all ever heard don't put all your eggs in one basket? What do you think that means? If I put all my eggs in one basket and I drop that basket, what's the problem?
Then you got no more.
Probably lost everything, right? Same way when it comes to investing, okay? I want to put some here, I want to put some there, I want to put some in different places. So I may want to buy bonds, I may want to put some in stocks, I may want to put some in mutual funds, I may want to do a lot of different things. We'll talk about all these later, I promise what they are, but I want to diversify, okay? I want to diversify, all right? So, just to give you an idea how much money you can make and what I was talking about by doing it early, it says, for example, if you invest $200 a month from the age of 20, that can make you a millionaire at the age of 65. Now again, guys, all this is based on you getting an interest rate of about 8%, I think. So you got a net return of about 8%, which is somewhat high. But if you took, guys, $200, how many of you are 20 yet? none of you, right? If you get $200 a month and was able to put it back and gain 8% return on a yearly basis, by the time you're aged to retire, you'd have $1 million to do whatever you want to do. That's at 20, okay? Now, if you started at 25, investing $200 a month, you'd make about $730,000. If you started at 30, investing $200 a month, you'd make about $500,000. If you start at 35, investing $200 a month, you're gonna make about $322,000. What's the common theme here? The older you get, the less money you're gonna make, right? So the idea is to invest early in good, solid investments. Okay, so the difference can be a game changer for you in your future finances, even if you start with small amounts. So basically, guys, what it's saying is, if you can invest, do it. You know what I mean? It would be good. All right. Does that make sense to you guys? Does anybody have any questions about that? Y'all with me there? Please tell me it makes sense. All right, so let's not confuse you now. I don't want you to be confused. How do businesses use investments to increase productivity? They invest in what? We literally just did this.
Nicer, better stuff.
They invest in better machinery, better equipment to be more efficient, right? What else do they invest in? People to give them education, experience to help them increase productivity, right? Then what's the one that you guys use all the time?
Technology.
Technology. Good. Y'all with me there?
Yeah.
All right.